सर्विसेज पे सर्विस टैक्स, मूवी पे एंटरटेनमेंट टैक्स, परचेज करो तो परचेज टैक्स और सेल करो तो सेल टैक्स, कभी तो ऑक्ट्रॉय तो कभी एंट्री टैक्स, बाहर गए तो सीएसटी, पर आ गया अब जीएसटी। Good afternoon, respected judges on the dais and off the dais, and all my friends sitting here. I am Neha Agrawal from the city of Oranges, Nagpur, standing before you to represent my topic, apportionment and blocked credit under GST. First and foremost, I would like to tell you why. Why do we need GST? GST helps in removing the cascading effect and unnecessary tax burden on the assessee. It aims at overcoming the various tax issues and provide maximum credit possible through its simpler and comprehensive tax structure. Now, considering that my audience have the basic knowledge, I would just brush up the mechanism behind input tax credit. The mechanism starts at the manufacturer and ends at the consumer. Being a multi-chain credit model, credit is available at each stage, but the ultimate tax burden is on the customer. Coming to the gist of the act, which major head can be set off against which other major head? The IGST payable can be set off against IGST credit and then CGST or SGST credit. The CGST payable can be set off against IGST credit and then CGST credit. The SGST payable can be first set off against IGST credit and then SGST credit. Now, my friends, can I claim credit? Can you all claim credit? No. There are numerous eligibility conditions attached to it. The person must be registered. The goods must be received. The receiver must be in the possession of the tax invoice. The amount should be credited to the electronic credit ledger. The return must have been furnished and the tax is paid. And the goods and services must be used in the course and furtherance of business. Now, does it mean that if all the eligibility conditions have been fulfilled, then every credit can be claimed? No. There are some credits that have been blocked under the Act. First, the case of purchase of vessels and aircrafts. The second, in case of motor vehicles, provided that seating capacity is less than 13, including the driver. But there are exceptions to it, my friends. First, in the case of transportation of goods, you can claim the credit. In the case of taxable supplies for the transportation of passengers, for further supply of such vessels, aircraft and motor vehicles, and in the case of driving and navigation services, the credit can be claimed. The credit can also not be claimed in the case of services of general insurance, repairs and maintenance related to such vessels, aircraft and motor vehicles. Other areas where credit is not available is food and beverages, outdoor catering, beauty treatment, health services, leasing, renting and hiring of vehicles, aircraft and vessels, membership of club, rent a cab, travel benefit to employees. In case of personal consumption, for the dealers under composition scheme, the goods or services or both received by non-resident taxable person except when the goods are imported by him. The goods lost, stolen, destroyed, written off or disposed of by way of gifts and free samples. Now moving to the next, in case of works contract for the services for construction of immovable property or when it is on your own account, the credit cannot be claimed. But it can be claimed in case of plant and machinery or when such works contract service is for further supply of works contract service. Now let's take some cases. The first one, when the input services and capital goods are used exclusively for taxable supplies. Is the credit available? Yes. When it is for completely exempt supplies, then is the credit available? No. But in the case when it is for partly taxable and partly exempt, partly for business and partly for non-business, here enters Rule 42 and Rule 43 under the Act. Rule 42 and Rule 43? Rule 42 is for the inputs and input services, while Rule 43 is for the apportionment of credit in case of capital goods. Now let's consider a case of butter which is used for manufacture of cookies in a factory and also at home at home. Will the credit be available in this case? The credit for the part of cookies will be available, but not that is used at home. Similarly, a printing machine being used for printing of newspaper and for calendar. The newspaper being exempt and calendar being the taxable supply, the credit related to calendar can be availed. Now, since I have given you the basic of Rule 42 and Rule 43, let's move towards the calculation portion. We have made some purchases of the inputs and input services. The supplier files GSTR1, which is reflected in our GSTR2A and is diverted to GSTR2. Now suppose there are 100 bills in GSTR2 and you need to mark it as eligible and ineligible. So the credit of these 100 bills, the 70 bills out of the 100 which relates to inputs and input services, the credit is rupees 11 lakh. This includes T1, that is for exclusively non-business purposes, say rupees 1 lakh. T2, which is for exclusively exempt supplies, say again rupees 1 lakh. And the part that is for blocked credit, like a rent-a-cab bill or a food and beverages bill, say 50,000. So, rupees 11 lakh will be reduced by 1 lakh and then 1 lakh and 50,000, and the amount of 8 lakh 50,000 will be automatically be credited to electronic credit ledger. The amount in the electronic credit ledger can be further divided into two. That is, one from the exclusively taxable supplies and the other being the common credit. So when I reduce 8 lakh 50,000 minus 60,000, that is for exclusively taxable supplies, we get 7 lakh 90,000 as the common credit. Now, as the name suggests, common credit includes all the exempt supplies, the non-business, and the residual ITC that is eligible. So, for calculation of the exempt portion, we will need the turnover under the exempt supplies divided by the total turnover in the state for the taxable period into the common credit. So, 5 lakh being the turnover of exempt supplies divided by 20 lakhs being the turnover of the state in the taxable period multiplied by 7 lakh 90,000, that is the common credit. We get D1, that is the proportion towards the exempt supplies. Now, if the inputs and input services is used for non-business purposes, the credit attributable to this is calculated as 5% of the common credit. So 5% of 7,90,000, 39,500 will be attributable to the non-business purpose. So 7,90,000 minus the exempt portion minus the non-business, we get 5,53,000, that is the residual eligible ITC C3. This C3 will be added to T4 that was exclusively for taxable supplies, and we get the final eligible credit, that is 60,000 plus 5,53,000 is equal to 6,13,000. Now, since we have talked about inputs and input services, let's move towards the capital goods. Suppose there is machine A, and we need to first of all find common credit. Then from the total credit, you will reduce the small a, that is apportioned towards the exempt and non-business supplies, say rupees 1,50,000, and small b, which is exclusively for taxable supplies, say rupees 50,000. So from total credit of 20 lakhs, you will reduce 1,50,000 minus 50,000 and get 18 lakhs as the common credit. Now suppose there are three assets. The first being AC, another furniture, third CCTV camera. You will calculate the capital A, that is the common credit for each of them, and then add them up to find TC. But since in our case there is only one machine, that is machine A, the aggregate of A, TC will be equal to 18 lakh rupees, and as per the Act, the life of the machine is considered as 5 years, which is equal to 60 months. So, the aggregate of A, 18 lakh rupees, will be divided by 60 to get 30,000, that is TM, that is the monthly common credit. So, now suppose that we move forward during the taxable period and purchase one more machine, machine B. And this machine B have the common ITC of 6 lakh rupees. This will again be divided by 60 and get 10,000 rupees. Now, why did I tell this? This credit will be added to the original TM to find TR, that is the aggregate common credit for the month. That is 30,000 plus 10,000 is equal to 40,000. Amount out of this, the proportion towards the exempt supplies, that is TE, will be calculated as the turnover towards the exempt supplies divided by total turnover of the state for the taxable period into 40,000, that is TR, and we get 10,000. Now, since we have seen the simple calculations, let's make it a little complicated. There was a machine that was earlier used exclusively for exempt. Later, it was transferred for common purpose, that is for taxable as well as exempt, for business as well as non-business. In this case, the credit will be calculated as 5% per quarter. The credit will be reduced by 5% per quarter from the date of invoice and then divided by 60, that is the life of the asset, and then added to TR to get the monthly aggregate common credit. Since a long time I have been telling you, exempt supplies, exempt supplies, exempt supplies. But what is included in this exempt supplies? The supplies under the reverse charge, the transaction in securities, the sale of land, the transaction under Schedule 3, the sale of building subject to Clause B, Paragraph 5, Schedule 2. Clause B, Paragraph 5, Schedule 2? What is this? For this, let's suppose there is a builder who have purchased steel and cement in bulk, and it makes a complex which have various flats that are being sold to the customer. The credit that is attributable to the flats that are prior to the date of completion certificate or first occupancy will be, we will see that, and the entire portion will be taxable. That is, if even ₹1 have been paid prior to completion certificate, the entire amount becomes taxable. But if it is booked and the amount paid after this, then it is not a supply and GST is not leviable on it. Thus, the credit for the period that is prior is available, but the credit that is later is not available. Coming to a specific sector, that is apportionment in the case of banks and financial institutions. Seeing to the numerous transactions of exempt as well as taxable supplies, the government have given them two options. The first one being to use the complex calculations of Rule 42 and Rule 43, and the second, to take 50% of the eligible ITC on the inputs, input services, and capital goods. But there is an exception to it. In the case of inward supplies from your own branch, 100% of the credit can be claimed irrespective of any other conditions. GST is a changing law, my friends, and thus subject to amendments. हर देश की एक ख्वाहिश होती है, हर ख्वाहिश के पीछे एक कोशिश होती है. मुमकिन नहीं सबके लिए बदलते देश को पाना. हमारे देश की एक अलग बात होती है, अलग बात होती है. थैंक यू.